Test, test. Zoom crew, somebody give me a thumbs up if you can hear me okay. Connor, Jake, Blake, somebody.
Yep, I can hear you.
All right, terrific. Thank you for that. Okay, gang, it's 5:30, so let's get going. We have a handful that logged in via Zoom, so We are a little bit light tonight in attendance. I suspect that's because we got football going on.
Keep on having lots of them.
I know, and I had a buddy of mine offer me tickets tonight, and I said, I got a piece, I canceled class last night, can't cancel class twice in a row. And this afternoon, I was rethinking that, I'm like, I don't think we can even there.
My boss is out there.
Okay. But we are gonna get you out of here by 6:30 tonight. We're talking about the bottom half of the balance sheet, so we're gonna look at the equity section. Briefly mention preferred equity, touch on minority shareholders' interest again, and then we'll talk about other comprehensive income a bit. Most of this is terminology. I'm gonna zero in on a few calculations where estimates are involved. Anytime we have an estimate, I'm trying to be very pointed about making sure that everybody knows this is not an exact science down to the second decimal point. There's a lot of estimation that goes on here, and anytime you have that, you have the opportunity for distortion, and you also have the opportunity to put your analyst skill set to work, which means you're gonna have to make any changes to the ratios and comparable financials and potential restatements of prior year's accounting. So I'm gonna talk about all that tonight. We'll get it done by 6:30. Before I just jump into it, this is module 8. So after this module, we have 4 weeks worth of testable material. I'll go out and open the exam, just like I did for the first exam. You'll have a 2-week window to go out there and take it. The scores from the first exam were right where I expect them to be. We got a nice standard normal bell curve, so that makes me think that the semester's unfolding like it should be. Any questions?
It's kind of, not really off topic, but kind of random. So when financial analyst gets a job or whatever, and they're working on, analyzing companies, a lot of these, like, I'm assuming, but a lot of these like ratios and formulas and things like that are already on templates like spreadsheets, and they just kind of plug and play for certain ratios that they need. The standard.
Pretty much.
It's not like
Yeah.
they're memorized what to do every time.
Yep, yeah, it's been, this was early 2000, 25 years ago now. I was doing it for experimenting up on my T-Mobile. But that's exactly what we did. We had a big database, and it was our job to keep our version of the numbers. So we knew what was going on at all of our competitors. And then my group was competitive intelligence. We were kind of lumped together with mergers and acquisitions. And anytime one of the VPs or directors wanted to understand our competitive position relative to or AT&T or what have you, we would give them the numbers that had been reconciled. So we had it all plugged into this huge database. It was an S-base. And every quarter, I would dial in to the management calls, the earnings calls of all of our competitors, and listen to what they had going on. And if we needed to make any adjusting entries, we do it right there in the database, and then it would flow through all the ratios. And we kept 2 databases. We had our proprietary version with the adjustments, and then we got an as reported database and back and forth. If anything ever changed, and you decided that, well, we really didn't need to do that, it was easy to toggle.
I see AI and like making dramatic changes, like the way we operate.
I'm sure. I haven't seen it yet because my day-to-day is a little bit outside of the financial accounting world these days. I mostly sit down with clients and talk about investments, and most of those conversations are very high-level asset allocation. So we do business with institutional clients and endowments and foundations and 401k plans, and what those investment committees really want to know at this point in time is, has AI as a segment of the technology industry, has it gotten too far ahead of itself? Is it out ahead of over its skis, so to speak? So most of the committees I've been talking to have come to the conclusion that now is the time to be taking risks off the table. We've had 3 excellent years of gains in markets. Nobody ever went broke taking a profit. Let's make sure at the very least we rebalance and are at the lower end of what we would consider to be an acceptable risk range. So. I mean, AI just accelerates that conversation, so when I need to get prepared to have that conversation, I can track down all sorts of returns for indices and specific mutual funds and individual stocks, and I'm better prepared to have the conversation. And I expect AI is doing the same thing for financial analysts. I get advertisements 3 or 4 times a week offering, um, offering, classes on AI and how you can better integrate it into everything from QuickBooks to Excel modeling to individual accounting. So, but I haven't used it yet, so I'm not the most knowledgeable person to speak on it. But it's incredible. It's incredible to see what it's done in the market. Any more questions? Okay, let's talk about stockholders' equity. And I want to hit the highlights of these PowerPoint slides. I don't want to go into every one of them because a lot of this module will be review in nature. But I want to touch on 2 key terms on this first slide here, which is the difference between book value and market value. Book value is exactly what it sounds like. When you open up the 10K and you find the balance sheet and you scan in the bottom of the balance sheet, there's a number besides shareholders' equity. That number is the book value of shareholders' equity. Easy. Market value differs from that a little bit. Very rarely you have the opportunity to buy a company for the book value. So theoretically, if we look at the balance sheet and you saw that all of the assets added up to $1 million, or let's call it $2 million, and then you have $1 million in liabilities, well, you ought to be able to just pay $1 million for that company and assume those liabilities and make a purchase. That's what accounting is supposed to be, right? So my question to you all is, why doesn't it usually happen like that? In order to make a purchase, typically you have to pay more than the value of the assets printed on the balance sheet. Why is that? Because you look at the assets on the balance sheet, let's just for the sake of argument say that they're stated at close to fair value. You can get some distortions, and we'll talk about some places where that happens. Let's for the sake of argument say that assets are worth what it says the assets are worth. They've been properly depreciated with no accelerated depreciation or anything like that. That's what they're worth. And then we know the liabilities are worth what they're worth because if we stroke the check to the bank, we can pay all those off today. And what we'd be left with is the equity value of the company. But you hardly ever get the opportunity to pay that for business. So if you could theoretically just go out and buy the same assets, the identical assets as XYZ company, you would have replicated the business. Now you have an identical balance sheet. You have all the same assets, the value is the same. So what is the difference between market value and book value? Why aren't all companies worth book value?
Like brands and like future earnings potential. Like you pay for what they've already put into the company and then also the future earnings. But they can possibly potential source of this is paying what they say, which would refund the value of that company. But then a certain amount of time to show that the money back. What do you continue to pay for?
We talked about it a little bit last week, or 2 weeks ago when I was actually here.
Coca-Cola, you pay for the Coca-Cola.
We looked at that merger accounting and we came up with a number that plugs that hole, which is goodwill. After we assign value to all of the intangibles that can't be recreated, we can't just go out and buy an identical set of assets and poof, have the same company. Because there's intangibles. That might be brand or culture or embedded distribution channels or other deals that don't show up on the balance. So that's a big difference between market value and book value. Market value is going to reflect that because investors are willing to pay for all of those intangible assets. They're willing to pay for that future opportunity that can come together. And that difference between what investors are willing to pay And the book value of what's actually printed on the balance sheet is the difference between market and book value. Now, on the next slide, our authors, maybe it's the next slide, but let me get to it. It's coming up. The average market book value ratio, that's 500, is about 3.0. That means that your average company trading in S&P 500 will be 3.3 times as expensive as what would be indicated by the book value of their assets. I think Johnson & Johnson is close to 6 times book value. And what you're looking at here is Johnson & Johnson's statement of stockholders' equity. Find this for the companies that you're working on this semester. Familiarize yourself with the common terminology. Preferred stock, we've talked about that a little bit this semester. Common stock. Then we're going to talk tonight about accumulated other comprehensive income, retained earnings, and we're going to talk a little bit about treasury stock tonight. But I need for you all to be first to familiarize yourself with that section of the balance sheet, and then secondly, be able to explain all of those terms and how they've moved over time for the companies that you're analyzing. Specifically, when in the last 5 or 10 years have they issued preferred stock and why? When have they issued common stock and why? When have they bought back their own stock and why? When a company buys back its own stock in the open market, it becomes something called treasury stock. And there's a whole bunch of ways that can be good and bad. Finance theory teaches that when your insiders, when your management buys back its own stock, that's a positive signal. Because who's in a better position to know what that stock is worth than the company's own management? And that makes sense. What I see in practice are dozens, if not hundreds, of examples of companies purchasing their own stock back that, to me, does not send a positive signal about what that stock is worth, because there's no correlation whatsoever between a management team's historical purchases of that stock and the subsequent performance of that stock. If it was a positive signal, as the conventional wisdom would suggest, then you should be able to track that over time. Well, let's go back and look at the last 10 years. Let's look at when the company bought back its own stock, and let's look at the timing of that. Did they time it well? Was that a good time to buy? We have the price movement subsequent to that. You just match that up. Purchase of stock, day one. Subsequent performance of stock. Is that a positive signal or a negative signal? Well, when there's no correlation whatsoever, now you start thinking about, well, why are they buying the stock back? You know, could it be that they're buying it back for other reasons? Could it be that they're buying it back because, well, it's a simple calculus in the earnings per share. If you have less shares, then your earnings per share is going to be higher, and if your bonus is linked to that, well, that might be a good reason to buy it back. In module 8, we'll be talking here in a moment about incentive-based compensation. What you see a lot of companies do is their incentive-based compensation is so large, the dilution effect becomes very mean. If you look at all the stock options awarded to management year over year, you're actually diluting your earnings base pretty good. And shareholders don't like to see that. We all collectively own a business together. We don't want to see our earnings per share go down year after year after year because we've given such a generous comp package to our management. One way to offset that dilution effect is to go buy treasury stock in the market. So with one hand, you're issuing stock, and with the other hand, you're buying it back, and on the net, you're going to be about the same. That's also a pretty good way. Later in the lecture, we're going to talk about how we record treasury stock. It's an expense on the income statement. And it should be. We have to have some measure to keep track of the economic drag on a business when we issue more shares. We're trying to buy up in more pieces, which means my piece is getting smaller. Properly record that, we need to put it on the income statement as an expense. So we can offset that expense by, or we can not offset it, but we can benchmark it, value it, by looking at the amount of treasury stock we would have to buy back to fully accommodate for that dilutive impact of the incentive-based comp. Other comprehensive income. You all have heard of the bottom line. When the world thinks of the bottom line, they think of net income. When accountants think of the bottom line, they think of net income too, but then they have this special category of stuff that is underneath the bottom line. And that's called comprehensive income. And that's all the stuff that the accounting world has looked at and said that is too volatile or too unusual to put on the income statement itself. So we want to create a special category for this stuff and relegate it down to something called comprehensive income. And that's for several reasons. Volatility is the primary. So we're going to talk about pension benefits. Defined benefit plans are kind of an anachronism. Not very many people save for retirement with a defined benefit plan, but they're still out there. And if you think about what a defined benefit plan is, I might have shared this story earlier in the semester, but my granddad, who's passed on, he retired in 1985 and built 66 and agreed to pay him a defined benefit throughout his life. So he collected a check from Phillips 66 from 1985 to 2002 when he passed away. And then the check went to his wife, my grandma, who's still alive. So she got that check in the mail every month from 2002 to 2025, and it's still going. That's a liability that Phillips 66 has to put on their balance sheet. So they had, from 1985 to 2025, they had 40 years worth of checks that they have to have as a liability on their balance sheet. Now to offset that, they have a $10 billion investment account that immunizes that liability, which is properly managed. Now that investment accounts in the market, S&P 500, we go through another great financial crisis, market gets cut in half. That's $5 billion worth of losses. Okay, that's why we have a category called other comprehensive income. Because you can't put $5 billion worth of losses on the income statement and still have the income statement meaning anything. Because you have all of the ongoing operations of the company, then you have a $5 billion loss, which dwarfs everything else, turns it all into basically insignificant data. As he says, let's just take that loss, put it down into other comprehensive income. What typically happens, and this was a great financial crisis too, you had 08, 09 down 50%, and then the market rebounds. So volatility very often will turn those entries into something that normalize over time. We'll talk more about that. Usually that's the case. But I like to point it out because I think it's a good place to go fishing, so to speak, because you will find value in that segment of the income statement that sometimes is just hidden. You'll hear me refer to this, hold on a second. You'll hear me refer to comprehensive income as the basement, because you have the bottom line and then you have something underneath the bottom line, so that's kind of the basement. I will also refer to it as the junk drawer, because that's all the stuff that we don't want to put on the face of the income statement. We just cram it in the junk drawer. Question?
So these like pension plans essentially, are they considered, do they have no line item, or they consider like long-term liability?
They're a long-term liability.
So it's like a pension plan, line, separate one liability with the company.
You might see it broken out. Companies have discretion as to how they want to report it. Most of the time, it's just long-term liability, and then you have to go down into the fine print of the 10K to get it broken out. You'll always be able to find it broken out. Sometimes you have to dig deeper than just the face of the balance sheet.
I think you'll see like a comprehensive income changing, I think payments, I guess. Everything that will income.
The comprehensive income changes with the gains or the losses associated with the investment. The liability, yeah, so the liability in and of itself is typically on the balance sheet. And it's just the gain or the loss that shows up in accumulated comprehensive income. And then when they make the payments, the liability will go down.
Okay.
And we have a whole module coming up on this. Okay, but we're talking about equity high level, so here's the calculation of book value per share. This was the data I was looking at just a moment ago, or reaching for just a moment ago. Johnson & Johnson's market book was 6 times, the median for the S&P 500 is 3 times. Why would an investor be willing to pay 6 times book for Johnson & Johnson when they could go find almost any other company in the S&P 500 and only pay 3.3 times book value? Johnson & Johnson is much more expensive by that measure, almost twice as expensive by that measure. What are investors thinking? And there's a lot that goes into something like that, but I'm just asking for some generalizations here. Ernie says that's the only reason. The only reason you would be willing to pay almost twice would be because you think the future earnings are going to be greater. So it all comes down to growth. There's something about that earnings stream that's more attractive, growth. Or you might be willing to pay more if you thought it was less risky. But most of the time, the answer to that question is growth.
So you think like over the long run, pay out more, it's less risky, may take you longer, but it's a longer term investment.
Yeah, risk and return, they're two sides of the same coin. So when you're talking growth, you're talking risk or return. And, if you're talking volatility or standard deviation or some other measure of risk, and there's less lower, might be a reason to pay just a little bit more for it. Okay, let's look at Johnson & Johnson's statement of stockholders' equity right here on slide number 9. And you see how it's all broken out. And this is what I want you to look for when you go find this. So I think this was 2023, and you see the changes from net earnings, dividends paid, employee compensation, and staff options right there, 2.4 billion, repurchase of common stock, 6 billion, and then how it affects each category. So the retained earnings, other comprehensive income / loss, common stock issued, and treasury stock amount. That's standard stockholders' equity table. Be familiar with yours. Let's touch on preferred stock real quick, just terminology. I think we talked about this earlier in the semester when we were in the bond chapter. And I made the point that much like bonds, preferred stock is a contractual arrangement between the issuer and the buyer or the preferred stockholder in this case. So that contract is not boilerplate. When you buy a share of common stock, you know what you're getting. Every share of common stock traded on the NASDAQ or NYSE is basically the same. It's a commodity, it's regulated by the Securities and Exchange Commission, that entitles you to your pro rata share of the earnings that business generates, and those earnings are going to be bound by the generally accepted accounting practices. When you're talking about preferred stock, that all goes out the window because it's a contract. And fine print in that contract can basically say anything that two parties agree to. So you can have yield rights, yield privileges, conversion privileges. As a category, preferred stock is a great place to go look for bargains because A, it has all this fine print associated with it. A lot of people are past that. But then B, it's often very illiquid. And anytime you're dealing with an illiquid market, you're going to have a mismatch between buyers and sellers. So if you're just patient, you can wait for that seller that's, they got one of the, they're going through a crisis of some kind, and they need to get liquid. Anytime somebody needs to get liquid, that's going to create a big discount. So if you know what you want, you've already done your homework, and you're patient, you can pick off preferred stock issuances at big discounts, and that gives you the opportunity to make outsized profits. Okay. Let me go. Authors give us the example of Danaher Corporation. This preferred stock has conversion privileges, and the company chooses to convert that stock to common stock. When that happens, you're gonna see these two highlighted entries show up on the balance sheet. First off, you're gonna see the conversion of mandatory convertible preferred stock to common stock. That's 1.6 billion. So that is a deduction to the preferred stock category at the top of the list there. And then underneath additional paid in capital, you're gonna see another entry or line item that says common stock issued in connection with mandatory convertible preferred stock conversion. So that's 1.6 billion. So really, you're just dropping 1.6 billion from the convertible category, convertible preferred category down into the common. And if you see anything like that, just make note of whether or not it's meaningful material. And if it is, find out what management's strategy is for doing that and draw it to my attention in your research report.
I just figure like, what, why would a company take with that? They're like certain reason why they convert them.
So that one was probably done. Here's an example. There's lots of examples, but what I see frequently is that a company will issue a class of preferred stock because they need financing. They need to raise $10 million. In exchange for that $10 million, they will agree to pay somebody a 10% yield on that preferred stock. But it can be converted at the right of the company. So the company is basically saying, yeah, we'll pay you 10% today, but when we execute on our plan to grow our business, we want the right to call that back because 10% is expensive. We wouldn't agree to pay 10% if we could go to the bank and borrow the money. So it's basically like a high yield type of investment framework, and it puts you in the capital structure right above the common stock holder. So the risk reward opportunity is price driven. But the company wants to say, well, they had a world of success, we want to call that back, so we're not paying such a high dividend. That'd be private. Okay, more terminology. Not gonna talk about that. Non-controlling interest. You will see this in the section of stockholders' equity. You'll recall from our earlier conversations this semester that non-controlling interest shows up on the balance sheet when we have conglomerates that have bought pieces of other companies. If company A goes up by 100% of company B, you don't have it. If company A buys 99% of company B, well, then you still have 1% of the company that's owned by somebody else. Now, the accounting dictates that we're gonna fully consolidate as if both of those companies were one. When you fully consolidate, you just laid claim to that 1% issue that is technically owned by non-controlling interest. Which is why we have that little line item that shows up on the balance sheet and it tells you, after all this accounting has been consolidated, what proportion of those earnings, what proportion of that equity does belong? 1%. If it is a meaningful number, and I don't expect that it will be, but if it is a meaningful number, then you get down into some questions about whether or not some of the ratios are going to be adjusted. But that's one of the reasons why I have everybody pick from the list of dividend aristocrats is these companies are so big and with storied track records that the non-controlling interests are typically very, very small. Notwithstanding, you might get a homework question about it. You might get a test question about it. You need to be knowledgeable about the way this is going to affect the ratios. So the non-controlling interest here, 250 million for General Mills. And the authors ask, which measure of equity do we use? Which would be most appropriate for our ratio? So return on equity. You want to use the equity attributable, i.e. the equity attributable to company shareholders, not total equity, just the company attributable to company share, equity attributable to company. Leverage ratios. For leverage ratios, we want total consolidated equity because we're using total consolidated leverage. So debt, we consolidated the debt, we need to use the consolidated equity to give us a good understanding of how levered that business is. Market to book ratio, we would use, equity available to common shareholders. So those are the types of questions that you need to have a conceptual understanding of when we get to talking about non-controlling interest. Okay, stock issuances. Really just be familiar with the terminology. So you have par value, additional paid-in capital, this should be all reviewed. This is gonna show up on in your 10K filing. Here, this is Coca-Cola. So Coca-Cola shareholder equity shows common stock. We have a 25-cent par value with 11.2 million shares authorized, 7.4 issued. Typically, when you file your S4 with the SEC, you ask for permission to issue more shares than you're gonna need. And that just makes it easier for you to issue shares next time. If you ask for permission to issue 25 million, you know, over 10 million, then the next time you need to issue shares, you already have that all verification. You don't have to file. Par value is a little bit of an anachronism. It gives a nominal value of 25 cents, or sometimes you see $1, sometimes you see a penny. It really doesn't amount to much. The additional paid-in capital will be the larger dollar figure when you issue stock. Coca-Cola has some accumulated other comprehensive income and treasury stock on their balance sheet there. Stock repurchases. I think I touched on all that. Okay. J&J repurchases 200 shares of common stock. They pay 120 cash per share in that transaction. Whenever you're asked to break down a treasury stock transaction or any transaction for that matter, you do yourself a favor if you can identify the cash. That gives you your starting point. So we know we just paid $24,000 for this J&J stock. So we're gonna debit cash 24,000, and we're gonna credit treasury stock for 24,000, and that's a contra equity account on the balance sheet, which will adjust our total equity. Now, what happens when we buy that back? So now we have treasury stock on the balance sheet. What happens when we resell it? Okay, not buy it back, we resell it, we already bought it. So in this example, let's assume the 200 shares of treasury stock are subsequently resold, and they're resold at a profit. We're gonna sell them at 125. We bought them for 100, or sell them at 125. So what's that cash? Start with the cash. Well, if we sell 200 shares at 125 piece, we're gonna end up with $25,000 in cash. Now, the treasury stock is on our books. We just booked it on that last slide. We just booked it. It's on our books at 24,000. So we have to cancel that out. So we're gonna credit treasury stock for 24,000. That gives us a zero balance in our treasury stock. So what do we do with the extra $1,000? We're gonna book that to additional paid-in capital. Now, we just made a profit. We bought our own shares at 1 we sold them at 125. Why? In this transaction, why don't you see a gain here? This is an equity account, this is an equity account, this is a balance sheet, it's an asset account. There's no revenue, there's no gain. That means it's not gonna show up on the income statement. Yeah, I was asking you a question because I really don't know the answer. I mean, sometimes I ask questions because I want you all to engage, and sometimes I ask questions because, I don't know, that's weird. So, say for example, this wasn't Johnson and Johnson stock that we bought. Say for example, this was Johnson and Johnson engaging in open market transactions, and they went out and they bought somebody else's stuff. They bought Pfizer or Microsoft or, well, if that had been the case, then of course there'd be a gain that you run through the income statement. But in this instance, because it's their own stock, they go straight to equity. So just recognize that it didn't hit the income statement, but that doesn't necessarily mean that the management team didn't add value. They engaged in a transaction that added an additional $1,000 in equity. So that's tantamount to a gain. They could distribute that if they wanted to. It's real cash. They could pay dividends with that or use it to fund their business. So they should get credit for that. Okay, stock repurchased and retire. What does it mean when we retire stock? We just looked at an entry that shows what happens when we buy stock back and it becomes treasury stock. There's another category where we buy stock back and it doesn't become treasury stock. We retire.
It's like cashing out stocks.
You're just, that's a good way to think about it. You're just cashing out, it doesn't exist anymore. When you buy stock back and you put it in your treasury stock bucket, or you can resell it anytime you want. You can take that stock, you could resell it, you give it to your management team, it's sitting there. It doesn't have an economic effect on the company anymore because it's owned by the company, which means it's effectively retired, it's not in use. But this is different terminology. This is officially retired. This is, we're gonna tear it up, throw it in the paper shredder, it doesn't exist anymore, we can't resell it, we can't reissue it, it's retired. And when we do that, the entry looks the same. We have the same $24,000 in cash, but now we don't have treasury stock. Whereas before, we were crediting treasury stock. Now we're gonna credit the common stock and the additional paid in capital for the same amount of the cash. And now it's gone. There's no treasury stock issuance. That value is effectively retired. You don't see that as much, but it's important that you all know it does exist and can happen. Why would a company retire stock? Well, it doesn't have any different effect on ROE than treasury stock does, because treasury stock's a contra equity, so it's kind of factored up too. Let's see. Nope. So our authors give us two answers to that question. I don't love them. So top level, companies increasingly repurchase shares with no intention of reselling. So this would be retire. To use excess cash or to reduce the breadth of share ownership. Treasury stock would accomplish both of those. Or B, in this case, repurchase shares are retired self canceling. So I don't have a great answer for you on why a company would do that. I know it can be done, and I know you don't see it very often, which is probably an indication that the use case isn't spectacular. And we are right back to analysts' adjustments. So just like with everything else we've been looking at this semester, once you understand how the accounting affects the ratios, the question is, well, Is that an accurate prediction of the ratio that we want? And I don't know if this case, but for our purposes, we're usually comparing the ratio of company A to company B, and we want apples to apples, so we have to look at the accounting embedded in both businesses and make any necessary adjustments. So, these are tools that analysts use to deal with the effects of treasury stock. If you've had aggressive buying of treasury stock by a business, then your equity number can become pretty small. So your first tool to reconcile that is to just pay attention to the metrics that aren't affected by treasury stock, which would be return on assets and return on net operating assets. That's my favorite solve because it's not really a solve, it's just look at return on assets. Then we don't have to worry about treasury stock considerations. Great. Beyond that, you can compute return on equity after adding back treasuries. So you can say, well, what would the return on equity be if there weren't all this treasury stock on the balance sheet? Yeah, okay, that might produce some insights, but the fact of the matter is, it is on the balance sheet, and the corresponding cash count that was there before you bought the treasury stock was not high. You kind of have to balance both sides if you're gonna make adjustments. And then lastly, you can substitute the market value of equity for the book value. So you could compute like a return on market value of equity instead of a return on book value of equity. And you could do that for multiple companies if you wanted to compare across the industry, and that might produce some insights. (8.3) Stock-based compensation. This was module 1. This is the very first assignment that we do in this class. I want you to analyze the proxy. I want you to understand how your management teams get paid. I want you to understand what that is linked to. And this is stock-based compensation, and it has all sorts of use cases. But for the most part, we do this to try to align management incentives with ours as common shareholders. And there's no perfect way to do that, which is why we study the distortions. Clark has theory, I like, that we shouldn't, have to relate this to something how wrong, but, like we shouldn't study, we should study contract law, because that's a better predictor of somebody's future behavior. So contract law codifies the incentives, and the incentives dictate the behavior. So you can spend 6 years getting a PhD in ethics, but that is not going to correlate to your future behavior as well as the incentives that are outlined in your incentive-based comps. So if we know what this says, if we know what the restricted stock awards are, if we know what the restricted stock units are, and the fine print that define those, and the vesting period, and the triggers, they get a management team paid, we're going to be in a better position to understand what their behavior is going to be when they have the choice of making an estimate with regard to a lot of this. Stock appreciation rights, employee share purchase plans. You've seen all these. And they come in lots of different forms, and they're contractual in nature, which means they're very hard to understand, and you have to get down into the fine print to really establish what's going on there. I mentioned expense recognition. Once you've identified the incentive-based comp plan, and for the sake of argument, we've issued 100,000 shares to our management. Now we have to know what that's worth. And what it's worth has everything to do with all of the triggers that I just went through. Vesting period, the stock price, and what it's linked to. We have to have some way of value. And we can use the Black-Scholes options pricing model, which is traditional in that it's been around for a long time, and it does a good job of pricing options, but with as much fine print as we see in some of these shareholder incentive packages, it can fail significantly You also see a binomial lattice model, if you've taken the options class, derivatives class, you might have run across that. That's another way to solve for the expense recognition. And then a third way to solve for it. Excuse me. Is just to do a rough estimate of how much would we have to spend to buy the treasury stock back in the market to completely offset the dilution associated with the options that we. That's a rougher estimate. But you see companies do that as well. Excuse me. Oh, gosh. When we get to the discounted cash flow analysis later in the semester. That's easy. Excuse me. We will spend a lot of time analyzing whether an expense is cash or non-cash. Because theoretically, the future value of the business is equal to the present value of all future cash flows. So we need to be able to identify a cash flow from just an accounting. And if it's a non-cash expense, like depreciation, then we're gonna account for it in a slightly different manner. Well, all that applies to incentive-based comp because technically these are non-cash expenses. We issue restricted stock units. That's a piece of paper, that's not cash. But ultimately, it will and does have a detrimental economic drag on the business. So we have to account for it somehow. So we pretend it's cash, even though it's not cash. And you see that most clearly on the statement of cash flows. I think we're looking at day here again. You have a statement of cash flows from 2020 to 2022, you start with net earnings. And then you immediately move to adjustments to reconcile net earnings to cash flow. So you have depreciation and amortization, that's the most obvious example. And then you have stock-based compensation. So this is what we would have expensed out. So that's embedded in net earnings, but it's no longer in cash flows. So somebody had asked the question earlier, I think it was about pensions, that's printed on the balance sheet, and it's not typically printed or broken out. Neither is stock-based compensation. The point of this slide is that when you need to find out what that number is, you can always go to the statement of cash flows, because there's going to be a reconciling entry for stock-based compensation.
A stock-based compensation comes from treasury stock, or they own sold stock, and they have like 11,000 shares, or they own sold.
They could do it either way, their prerogative.
I guess like no difference, except that like pay treasury stock.
Well, you gotta go back to that other slide. This is all stock-based compensation. So don't think of it as stock, think about it as some options / contractual package that takes the form of one of these things. And then when the CEO actually gets his or her hands on the stock certificates, is based on the fine print in something called restricted stock. So the management team just has to account for that on a go-forward basis. So quarterly, they would sit down and make some assessment about whether or not they properly expensed that. Okay, I'm gonna skip over stock splits and stock dividends because they're very straightforward. And I want to get to, here we go. This is the section on comprehensive earnings. Dude, someone's got me out of this one up here. So when we get talking about that junk drawer, there's 5 major categories, and then there's a whole bunch of subcategories beyond that. Find the table in your 10K filing that details what's going into other comprehensive incomes and any big movers on that table over the last 5 years. Now, what is it for your company? And what I expect for many of you to see is that foreign currency translation adjustments are a big part. At the end of the year, Apple, Microsoft, Boeing, Ford, they're all multinational companies. They do business all over the world. So they have euros and yuan and yen and renminbi and you name it. Baht. What do they do with that currency? Well, they don't do anything with that currency. But somehow they have to report it as if it were US dollars. You know, you open up a 10K and it says, well, we got 100 billion in US dollar denominated assets. And that's not true because they have assets all over the world. They had to go through a process to determine what that number is in US dollars. And that process is a translation. At the end of the year, we'll translate all those assets back into US dollars. And that will produce a gain or a loss. Because all of those currencies fluctuate relative to the US dollar. So if you had a strong year and the US dollar is up, well, all of those foreign denominated currencies are going to translate into fewer dollars. That's going to show up as a translation adjustment loss. And that can be a huge number for global companies.
Is that the day of value of the dollar versus the yen, or is that in like the average of the whole year of yourselves? Then take it.
Yeah,
Does that make
so
sense?
yes and yes is the answer to that question. The balance sheet is as of a date in time.
Yeah.
So the balance sheet is there. The income statement is the average over the period. So it could be a year or it could be a quarter.
But when they, I guess, converted from yen to a dollar, is it the value of what the market is paying for a dollar that day, say December 31st?
Yeah, the balance sheet is.
Of that day?
Yeah.
Okay.
So that can lead to some very large distortions, which is why that's in the junk drawer. We talked about employee benefit plans. Those gains and losses can be huge. Gains and losses on marketable securities. So if it's an equity, that flows through to the income statement. That's netted. But if it's a debt security, then we have several categories. We have trading securities, and if it's a trading security, it flows through to net income. We have a second category of debt security called available for sale. And if it's in that category, then any gains and losses on those available for sale debt securities end up in comprehensive income. And then lastly, you have a third category that's self-explanatory called held to maturity security. So if it's held to maturity, you don't mark your markets. Which is, that means it's another place to go fishing for value. Because if you're not marketing to market an asset and it's appreciated, well, it's not showing up on the financials, but it's there and it's real. So if you can find it, you can exploit the market and get bargains. Gains and losses on derivatives and hedges. Hedges is the key word. And I want you to contrast that to speculation. If we just go out and we buy a bunch of derivative contracts, then the gains and losses on those contracts are going to flow through to net income. But if we go out and we buy a bunch of forward contracts on jet fuel, because we want to lock in the price of our fuel, and because we're Southwest Airlines, that's a hedge. And hedges, gains and losses on derivatives associated with hedges, flow through to comprehensive income. Same thing if we want to lock in interest rates before a bank, that would flow through to comprehensive income. So here we have all those categories lined up. Look for this table, see how your comprehensive income is changing year over year. Foreign currency, securities, benefit plans, hedges. And then you'll see a lot of other categories, but those are the big ones. And I think that was it, gang. Yep, that was my lecture for tonight. I'm gonna let everybody get off to Chiefs game unless there are other questions that you want that on the podium here. All right, go Chiefs. I'll put out an announcement when I get the second exam posted. Count on 2 weeks to take that, just like the first one. And let me know if you have any questions in the meantime. Yeah, you too.